The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
This is the Option Industry Council's Wide World of Options. Before we start today's show, investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, Characteristics and Risks of Standardized Options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell a security or to provide investment advice. Welcome to the Option Industry Council's Wide World of Options. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. OIC offers a variety of resources to those interested in learning more about options, including live seminars, webcasts, and podcasts. Check out www.optionseducation.org for more information. Now, here's your host, OIC's Director of Education, Joe Burgoyne.
Welcome to the inaugural show of OIC's Wide World of Options. I'm your host, Joe Burgoyne. Our show will try to cover all things options. The focus each show will be a strategy spotlight segment with an industry expert who will dig into the nuts and bolts as well as the nuances of that week's strategy. Also on our shows, we'll discuss what's hot in the options industry, have interviews and discussions with other option experts and industry leaders covering a variety of topics. We'll offer resources and tools for you to use and hopefully lots more. I thank you for joining us today on our inaugural show and hope you'll make OIC's Wide World of Options a regular habit. Before we get started with our strategy spotlight segment with Peter Lusk of CBOE, let's talk a little bit about one of the hot products in the industry, weekly options.
It's time to get a handle on the latest developments from the world of options. It's time for Industry Happenings.
Started as a pilot program a couple of years ago, these weekly options really have taken off. I mean, at this point, overall, the 11 option exchanges have just under 4,000 underlying products. And of those 4,000 products, about 175 have weekly options. And of those 175 out of the under 4,000 products, the weeklies are actually doing somewhere in the neighborhood of 15% of the average daily volume in the industry. So you can see these are incredibly liquid instruments and popular at the same time. The whole weekly product idea started as a pilot program. We started with, I think, 5 weekly options a few years back. And as I said, we're now up to just about 175. Recently, weekly options have begun to get listed on some issues on 5 consecutive weeks. The weekly options get listed on Thursday and then expire the following Friday, assuming that is the trading day. One more thing about the weeklies, and I think it's part of the reason why they're so popular. Obviously, there's not a lot of time. And so with that, you really have a very dynamic component in both gamma and theta that comes along with these weekly options. So something to keep an eye on. About 175 actively traded products right now are those weekly options.
It's time to break down the latest option strategies. It's time for Strategy Spotlight.
Joining me on Strategy Spotlight today is Peter Lusk from the Chicago Board Options Exchange. Howdy, Peter.
Hello there, Joe.
Thanks for building time into your busy schedule to join our listeners today. Before we get started on our strategy today, how about if you tell us a little bit about yourself?
Okay, sure, Joe. I traded options on the floor of the CBOE for 10 years and a few more years on top of that off the floor, which has become the latest trend.
That's for sure.
And currently I'm an instructor for the Options Institute, which is the educational arm of the CBOE. And we do all sorts of things just like this. I just got back from Seattle, Washington. So that's what we do, options education, and education is good.
You got a team over there at the Options Institute that you work with, isn't that right?
Yeah, we got a good team. It's Jim Bittman, Marty Kearney, Russell Rhodes, and myself, all former traders.
Fantastic. All industry leaders as far as the options education mission goes as well. So
Thanks, Joe. We like to think so.
Good stuff, Peter. Now, Strategy Spotlight, the whole idea of this segment is to try to maybe get in a little deeper to some of the various option strategies we're out there. And, your idea was to discuss the bull call spread today. So why don't you tell me, first of all, why you chose that strategy?
Well, you know what? Through my teachings, boy, I sound like a prophet, don't I? Through my teachings. What I'm really talking about, though, is, when I speak with beginning option traders, it's kind of fun to graduate them from just being a call buyer or a put buyer. And what I mean by graduating is actually have them get into the scenario of starting to do spreads. And they see the value of spreads. When we're talking about buying a call, and now we're going to move into this bull call spread, we're not only buying something, but we're selling something as well. And after going through it, and I hope today we go through it too, they see the value of it, which is really important.
It seems like a wonderful natural progression, for the investor. How about the bulk call spread? Why don't you start by explaining exactly what that is?
Sure. Well, first of all, just buying a call, I'm sure all of your listeners understand that that's a very bullish strategy, but sometimes call buyers have these unrealistic expectations, including my brother, who I've been tutoring a little bit on options.
Unrealistic expectations. I find that hard to believe.
Well, you know what? He's the kind of guy, and there's a lot of people just like him that just look at the goodness of the trade, and when they buy the call, they think the underlying is going to go to the moon, and I hope it does for them, but typically it really doesn't. So the plan is to actually buy one call and sell another call on top of that, where you have realistic expectations. What I mean by that is, where do you think the stock is really going to go? And that's going to be targeted with the sale of another call.
Okay, so that it sounds like that opinion of the underlying is critically important, and then where you anticipate it potentially going, helping you to define maybe which strikes to buy and sell.
Exactly. Let's just say we've got a stock that's trading 68. I may want to buy the out-of-the-money 70 strike call and sell a 75 strike call. So my hopes are possibly in the next 45 days that this stock will rise from 68 in a slow rise all the way up to my chosen strike price of 75 up on top. That would be my target price. And the good thing about it is that when I'm buying this one call, as you know, Joe, it's all time decay. But when I'm selling the other call, which is also out of the money, it's also all time decay. So the plan for me would be to have a gradual rise to that call that I sold so I could take advantage of the time decay on that guy.
Now, when you're talking to your brother, do you offer him patented Peter Lusk secrets?
Secrets? Only for a cost, just kidding. He's a funny guy. He lives on an avocado farm in San Diego, just outside of San Diego. And he always sends me bushels of avocados that I can't even go through. So, yeah, we take good care of each other. But, yeah, here's the thing. The bull call spread is a great strategy. They're all great. But it really just comes down to the performance of the underlying. So with my brother or with anybody else, if you've got this outlook, you just don't want to have the outlook because you fell in love with this particular trade. Your outlook has got to be real, and it's got to be based on things that you believe, things that you see, maybe the product, maybe the customer service, whatever contributes to your opinion on the underlying is going to be really, really important.
Well, I really like the way you are emphasizing that whole idea of the direction of the underlying, because remarkably, so many investors who we speak to, there's a bit of a disconnect sometimes between, well, options are options and the underlying is the underlying. So I love the way, how you're just emphasizing, how they work in tandem.
Yep, great point. And, the options are related to the underlying, and I think this is where you're going with it. When we're looking at option pricing, they're priced in expectation of a particular movement in the underlying. If options are pricey, we can expect maybe significant movement in the underlying. And if the options are kind of on the cheap side, maybe nobody cares, and the underlying is just going to kind of sit and lay around. So, yeah, you're exactly right, Joe.
Now, Peter, is there any secret sauce to deciding, which strikes or which month when you're putting on a bull call spread?
Well, you know what? Not really secret sauce, but for me anyway, it's just
secret avocado?
Secret avocado, exactly. Perfect. I'll have to pass that on to my brother and tell him we spoke about his avocados. You know what? It's really the most important thing is going to be the expectation of the movement of the underlying and then time. So when you're putting the trade on, what is influencing the time? Maybe you're putting this trade on in advance of earnings with an expectation of the underlying going higher, and maybe you're going to put this thing on just that earnings week. Maybe you're even going to do it with weekly options. So that all plays into it for sure.
You talked about that one example. How about if you walk me through another example or two and really get into the potential risk reward?
All right, sure. Let's just say you've got a stock that's trading $68 a share.
Okay.
All right. And let's just say that you think this stock is going to go from 68 to 75 by the third Friday in April. So the plan is to purchase one April 70 call, and let's say we're paying $3.60, which is all-time premium. That 70 strike call is $2 out of the money, and I feel like this underlying is going to go up to about 75. Let's sell the 75 call for $2. So I paid $3.60 for the 70 call. I sold the 75 at $2, so my net cost is going to be $1.60
Got
to
it.
me.
Okay.
All right? So that's the first thing we're looking at is if I just buy the 170 call all by itself, I'm looking at $3.60 or $360 with this expectation of going to the moon. But
Per
being
contract.
realistic, just for the one contract. So the first benefit by selling the 75 call, I'm spreading off the cost of getting into the game.
Okay.
Now I'm into the game for 160 as opposed to 360 because guess what? I'm buying something and I'm selling something. So the most I can lose with this trade is going to be what I paid for it, which is $1.60. As far as break-even points, remember the stock price is at 68. I've got to go from 68 just through that first strike to 71.60 to cover the 160 that it cost me to put the trade on.
Okay, so it's the strike that you're long plus the debit you pay to get you to your break even?
Exactly.
Okay. And how much did you make?
Well, it's going to be the difference in the chosen strike prices. 75 is the strike that I sold. 70 is the strike that I bought. The difference in those strikes is 5, less the debit that it cost me to put the trade on, which is $1.60. So the most I can make is $3.40.
Okay, you're good with your math. Very good. So if you did the 70-80 spread and you did it for $1.60, you could make, what would that be, $8.40, but the stock would have to go to 80.
That's right, but also it would be tough to do it on this first example for $1.60 because we sold the 75 call for $2. The 80 call that we sold would be more like maybe 80 cents perhaps because it's further out of the money, so we're not going to be able to collect that much time premium.
Good point.
But you're right, though. It's always going to be the difference in the strike prices, less what you paid for the spread, and that's going to equal your maximum profit.
All right. Well, just listening to you talk, it sounds fairly obvious where we want the stock to be at expiration. But why don't you hammer home that point a little bit?
Sure. We want that stock to go right up to 75. And the psychology behind it is really a slow and gradual rise to 75 so we can take advantage of the time decay of that $2 option that we sold. And time decay is very important because, remember, when I'm buying the 70 call, I'm buying time decay. When I'm selling the 75 call, I'm selling time decay. So we're offsetting the time decay to a certain degree, but I want time for that 75 call to decay to maximize my position.
Okay, crystal clear. How about looking at this from a different perspective, the idea of delta? When an investor is trying to choose what strikes, is delta a consideration in the spread?
You know what? Not for me. Delta is not a consideration. For me, it's choosing the right strikes. And in this case, I'm choosing my first strike that I'm going to buy, which is $2 out of the money. And I'm doing that for a reason. Number one, I'm getting in the game. If I go by delta, go further deeper in the money, I'm talking about buying a more expensive option. So I'm giving up a little bit in anticipation of some significant movement. So that's how I choose my strikes.
Okay, so backing up a little bit there, rather than do the 75 bull call spread in your example, you would stay away probably from that 65-70, which would cost you more?
Yeah, it would cost me more, and also the stock is already at 68. And so for me, I'm just looking at using the out-of-the-money options most of the time, or I'm going after the at-the-money option. So if you do want to ask about delta, I'm probably always a 50 delta or more, or 50 delta or less, I should say, on the call that I'm buying.
Okay, very good. And, what's interesting about the option space and really the investment space is that oftentimes each investor, creates his own rules. And, here you are, talking bull call spreads, and you've obviously created your own rules on how you find most success with this particular strategy.
Yeah, that's exactly right. You get comfortable with certain strategies on certain underlyings, and you just get a feel for how to do it. And Joe, as you know, through our travels together, I was in a pit with 16 stocks, and I tend to now have a virtual pit of about 16 or 18 stocks, meaning, I can pick and choose what I want to trade, but I make it manageable. I don't follow 45 or 50 stocks. I hear about them, read about them, but in my watch list, I've got about 18 stocks, and I find myself becoming more successful, just like in the pit, just following the behavior of these handful of stocks. And one more comment, this year alone, I've only traded options on 5 different stocks out of those 18.
That's interesting. That was going to be my next question. And one on top of that, how many various option strategies do you use in your universe?
That's a very good question. I would say this year maybe 6 or 7.
Okay.
That's it.
Here you are, a guy who's been in the business for a long, long time. When we're out there on the road speaking to investors, I think it's important to try to hammer home this idea that there's so much out there. Don't get consumed by trying to know a little bit about a lot. Really focus, as you say, on your underlyings, know your risk tolerance, and then pick a couple option strategies to then build on. Make sense?
So unbelievable. I mean, that's something that I tell people all the time, what you just exactly said. And when I meet people during my travels, someone will come up to me at the intermission. I'll say, hey, all I've been doing is selling puts on XYZ every month. And I go, if it's working for you, he goes, oh, it's been working for me for like 2 years. And that's all I do is that one trade on that one stock. And that's exactly what you're saying. That's where you want to be at. You want to find something that works and just keep banging it out.
Dynamite. Let's talk about managing the bull call spread at expiration. If the stock gets close to the strike, how do you go about managing this spread?
You know what? My whole thing about expiration is I'm fearful of it because of all the years that I've been around it. Expiration creates some sort of anxiety and some panic once in a while. And so I find myself, when I'm in the profit territory and it's acceptable profit to me, I tend to close out the trade. That's my plan. I close it out and move on because there's more things to do. I don't like the uncertainty that can happen sometimes at expiration. I mean, I'll tell you a story if you want to hear a story.
Heck yeah.
Here's a story about this very thing in the pits here in Chicago. All right, typically market makers don't like to trade with each other. And it's expiration Friday here in Chicago, and I'm short 300 call options in a specific underlying stock. And I've got 5 other fires to put out on expiration with things, expiring and being short, being long, and so forth. Here was my plan. I'm gonna buy in these call options, and I'm gonna pay the market maker's offer, even though I'm a market maker. I'm gonna take these things off because I got bigger fires to put out. So what I said was, XYZ stock, I'll pay $1. 300 times, and the market maker shouted back, sold, sold, sold. And I said, 100, 100, 100, I'm out. And I moved on. So the market was 80 bid at $1. I paid $1 because I just wanted to get out of the game. I knew that months earlier, I had already sold these calls for $3 and $4 a piece. What's wrong with taking them off for $1? Well, this is one of the success stories of the pit. Later that day, those calls were trading $4 a piece. All I was doing was closing out my short call position. And yet by closing it out, I did really well. And not to say, Joe, that I've done well all the time. That's not the case. I've got horror stories too, and I'm sure you do too. But that's just a story that I like to tell because I like to close out the option position to avoid some sort of train wreck on something that was going just fine.
And you're speaking right to the heart of the matter, and that is managing risk, Peter. And in that case, you managed it beautifully.
Exactly.
What about the whole idea of implied volatility? Is that a factor, when we're talking a bull call spread?
Yeah, I think so, big time. Good question, because if I'm going to buy that 70 call and I want to sell the 75 up on top, what if the 75 call is only 45 or 50 cents? For $50, if I do it one time, or $500 if I do it 10 times, I might just say, forget about the realistic expectation at 75. Now I'm just buying the calls. So implied volatility is going to tell me a lot, as if, do I want to sell a call up on top? Or implied volatility is going to also tell me if these options are kind of on the cheap side, I might not get that expected movement or that movement that I believe in, because those options are just priced sometimes very precisely by the marketplace itself.
And is there any specific way you go about determining whether the implieds are high or low?
Well, you know what? Another good question. Actually, you get a feel for it. You just get a feel for it. New option traders might want to look and see what the volatility is and so forth. But after a while of just following a handful of stocks, you get to know, and you'll say, these are kind of pricey this time around, this earnings period. You get to just have a good feel for it, a gut feel for it. And then, on top of that, there's something else that market makers, pit traders like you or myself, what we used to do, Joe, you might recall, is pricing the at-the-money straddle, meaning I could add up the at-the-money call and the at-the-money put. And let's say the call is 205 and the put is 2. There's this expected movement of the underlying, either up 4 or down 4, based upon what the market is implying with the price of the options, and that's implied volatility.
And that I love that little trick and often talk about it. It's a great way for investors to get a sense for the market's expectation on movement, is that at-the-money straddle.
Right.
When you are talking about this implied volatility for our new listeners, I mean, where can they actually find it? If they don't have a month or two to just get comfortable, where can they go find, something like implied volatility?
Well, a great place is your platform, Joe, which is the OIC. And you've got that wonderful options calculator. And they can kind of back into that volatility. They can put in the calculator the price of the option that they're seeing. And what comes for the output is that volatility component. So, yeah, the options calculator is a great, just a fantastic tool for the new option trader.
Excellent. Just a couple more things, Peter, maybe before we wrap it up. Now, you picked the bull call spread. So many things in the options space kind of mirror one another. Is there another vertical spread strategy that mirrors the bull call spread?
Yeah, that would be the bull put spread, actually. And so sometimes option traders may want to price both of them out and see which one, with their bullish sentiment, might be maybe a nickel better to do.
Give that to me one more time, only because I think it's easy to get confused when you're talking, the 4 different vertical spreads.
Sure. Well, let's just say, and everybody that's listening, maybe pull out your number 2 pencil now. Let's just say that I buy a 50-strike call and I sell a 55-strike call. There's my bull call spread, all right? And I could do that for a net debit of $3. How about if I look at the puts and I'm still bullish and I do a bull put spread, and let's just say that I'm going to buy the 50-strike put and sell the 55-strike put, and let's just say I can do this for a net credit of 2. All right? So the difference in the strikes with the bull call spread is 5, less the net debit of 3, I make 2. With the bull put spread, the difference in the strikes once again is 5. I've got a credit this time. All right? So the maximum risk is going to be 3, and the maximum profit, just like the bull call spread, is going to be 2. So those positions are synthetically equivalent.
Excellent. That is, one of the nuances in the business, and, thanks for making that so clear. Before we do wrap up, are there any other little tidbits you'd like to offer about, this bull call spread strategy?
No, I don't think anything more about the bull call spread. It's just that maybe we end it like this, is that there's so much great education out there, including your website and also the seminars that you put on that we're invited to speak at. And we not only delve into the bull call spread, but we also talk about this all-important price behavior scenarios, too, that we always get into. I think new option traders, it does look somewhat simple at the beginning, but you know what? You're really ending up trying to deal and take advantage of this time decay and volatility. And I think education, the continuance of education, is going to help anybody. Hopefully, you like it enough, and hopefully you'll get better at it by continuing to educate yourself. Because one last comment, look, for me in the trading pits, I didn't make any money for the first 13 months.
Who was counting?
I was counting, and so was mom. So was mom at home. She said, "Peter, I love that you're having so much fun down there with all those guys. This is like the fraternity that you never had in college. But you know what? When are you going to start turning a profit?" And you know what? I say that really in a good way, because tongue-in-cheek, I mean, she's been with me for 30 years of marriage, and so we get it. We can say anything we want to each other. But that's the truth. It really comes down to liking it enough. If you like it enough, you're going to be good at it, I think. And you've got to put in the time to educate yourself, just like anything else.
Peter, thanks, man. Really appreciate your insights on the strategy, and look forward to seeing you out on the road before long.
Great, Joe. Thank you so much for having me. I always love talking to you.
Same here. Bye-bye.
Bye now.
It's time for a nostalgia break. It's time to take a look back.
Well, with today's looking back, how about if we start, at the inception of the options industry? That date was April 26, 1973, when the Chicago Board Options Exchange was incorporated. At the same time, the Chicago Board Options Exchange Clearing Corporation was founded as well. Now, we're talking April 26, 1973. It wasn't, too much later. It was actually December of 74 when the stock market bottomed at 555 in the Dow. So it's kind of interesting to me that the options industry, happened to start right before a major low in the stock market. And actually many chartists and market historians do look back at that December 74 low as the beginning of the great bull market. Others, point to August of 82. But, it was the options industry that started back in 1973, that day, April 26th. A little more about when we got started. 16 underlyings is how many options started that very first day in Chicago. And after the day was done and that bell rang, take a guess how many option contracts traded on those 16 underlyings. A whopping 911. But we were off and running with the beginning of a wonderful new industry in the U.S.
It's time to upgrade your options toolbox with cutting-edge trading platforms, devices, and information. It's time for tools, resources, and good reads.
The final segment on our shows will be tools, resources, and good reads. To wrap up today's inaugural show, I'd like to offer two different ideas. First, on the tools side, please be sure to check out the volatility charts at www.optionseducation.org. That's our website. These volatility charts are full of lots of information. You know, how much time premium in the options over the course of the last year. You'll get a couple things on these charts. And actually, you can get a chart for any underlying that has options on it, and you'll get both the implied and historic volatility over the last 12 months. So they're the implied volatility charts. Please be sure to use them, and you'll find them at optionseducation.org. Lastly, I want to leave you with an author who has actually written 4 books on options, and that's Jim Bittman, our esteemed colleague over at the Chicago Board Options Exchange, who also acts as an OIC instructor from time to time. I would urge you, Google Jim Bittman, check out his 4 books, and you'll be on your way to furthering your options education. That wraps up our show for today. I hope you'll join us next time when we'll be joined by Bill Ryan of New York Stock Exchange ARCA. He'll be discussing selling puts, how to sell puts to both generate income and acquire stock. We'll also be talking about a new product that's just been launched, mini options. Also, we'll have a guest appearance from Jill Malinadro from the street. Well, that's it. Again, thanks for listening, and hope you'll join us again for OIC's Wide World of Options.
You've been listening to the Option Industry Council's Wide World of Options. If you have questions about anything you heard on today's show, email Joe Burgoyne at options@theocc.com. Or you can call OIC's Investor Services at 1-888-OPTIONS. Interested in connecting with OIC on social media? Like the OIC page on Facebook. Follow them on Twitter at options_edu or join their group on LinkedIn. Thanks for listening, and be sure to check out our next episode of The Wide World of Options.
The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.